There is one stock that is about to skyrocket. The company is a retail company. Ulta Beauty, ticker symbol ULTA, over $2.5 billion in revenue, up 10% year over year. Another retail stock with 10% year over year revenue growth, over $1 billion in revenue. Urban Outfitters, ticker symbol URBN. So it turns out mainly women still want to shop, and a lot of these sales are coming online. However, for products that you want to try on, it's still interesting to go in and try those on. And it's not just Urban Outfitters and Ulta Beauty, not that you try on makeup, but I think this company does a lot of e-com sales. Kohl's as well had a big quarter, and Abercrombie and Fitch, ticker symbol ANF, and I guess it would be AEO, American Eagle, AEO is the ticker, also having solid earnings reactions. So it was a big quarter for retail. It's easy to say that's just because of Black Friday and future Christmas shopping. But it's not just about sales, it's about beating expectations, and expectations have been met. The reactions are strong, and these two tickers, Ulta and Urban, look to be shaping up the best with the best risk reward right now. Let's jump into these two stocks.
This is Sam Putnam.
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 All right, so this is Ulta Beauty, 2.9 billion sales, up 10%, a little more than that year over year. Same store sales increased as well, so they're not necessarily closing sales. It's interesting how same store is measured now. It's comparable stores, so it's per store plus e-commerce. So I think they must take the total e-commerce sales and then divide them by the number of stores. But somehow they figured out to have a solid margin and make money based on, it sounds like, charging more or getting the clothes for less. It's not really, or getting the makeup for less. It's not a idea particular to Ulta Beauty. I mean, if you look across, they actually opened 28 new stores. That's pretty incredible. Closed 15, but still. Look at these stock moves. I mean, Ulta's up a lot. Urban is up a lot as well. Kohl's is KSS, that's up a lot. And AEO, ANF, I mean, just across the board, retail earnings have been super solid. And it hasn't been followed by, good just consumer earnings. If you look at some of these food stocks, Eat and Shack, Dash is sort of related, but they do food delivery, so it's a little separate. But airlines, or actually these are cruise lines, so it's not quite the same, not doing great. It's at the same time, the airlines have been doing a little bit better. So generally, at a time when, say, COVID, it was super obvious what's going to do what. I mean, airlines are going to not do well, right? Cruise lines are not going to do well until everything opens up, and then they go up. But right now, it's a little bit of a mixed bag. I mean, airlines doing well, cruise lines not doing well, food not doing well in terms of fast food, basically. And then these retail stores doing really well. So I think it makes sense to look more within a sector rather than across what are sometimes correlated sectors. So I think retail is a good place to look. So here's how this stock is shaping up. You definitely see a flag forming here, and might go, might not, but the way to do it is to say, hey, I'm going to buy over 77.3. So hopefully this doesn't gap up, hopefully it goes sideways or down a little bit. And then risks, say this high, risk 77.3. So risk 25 cents to make $2.50 or a lot more. Maybe risk 50 cents to make $5, but that's Urban Outfitters. And then Ulta Beauty is a little different because, it just hasn't gone sideways as much. So you have this high volume close. You see all the volume. It's high, highest right here in the last year. And you can buy over that level of 600. It's super special, simple psychological level as well. So risk a couple dollars. It's at 602, assuming it goes sideways today, tomorrow, the next day, whenever you see this, and buy over that. Try to make $30 on a risk of $3 up to 630 or so. So super strong, and trailing off volume is completely normal for these companies. And if we can kind of take any lessons from other high volume close opportunities, KSS hasn't done it yet. You still have the same sort of opportunity here where 22.5 is a place to buy it over. So it's holding that right now. I mean, maybe the opportunity was today or yesterday, but there's 22.5. So it actually broke it here, but maybe tested it here, broke it went slightly below. But the idea here, right, is you buy somewhere in here, and maybe you hold through this. Maybe you're asleep at 9:30, you're at work, whatever. Sometimes you just very quick moves, you don't stop out. Maybe you throw in a stop, maybe you don't. I'm not going to jump into that too much. That's like the reality of trading and investing rather than the risk reward theory that we're talking about here. But it is what it is. Let's say you got in after this move down, and sometimes actually these move downs are in pre-market. Now this one was in regular hours, so it actually should have stopped you out. But if you do get in somewhere up here, 23.25, you're risking 75 cents to 22.5. So you really need to make $7.50 up to 30. And it's totally doable on this chart, looking at a 5-year chart to get to 30. We're just getting over the 200-day moving average. So that's kind of the risk reward you would be looking for on a stock like that. And again, to use this high volume close just language a little better, Guardian Health, another example. Like there's going to be some rough days. So November 4th, for example, was a pretty rough day here in terms of, let's say you got in before that. That's going to be difficult because, it stops you out, except you probably don't have a stop in after hours anyway. So in reality, that's probably okay. But if you look at a 30-day chart, this is super trader talk now instead of talking about fundamentals, but I'm just trying to level with you here. If you go to 92 as your high volume close right after the earnings, and you can see how it held it pretty clearly here. If you buy here, you risk that level, maybe you risk $1. You just stick above that level, and you're in at 92 one of these days. You've made $6 so far, and then you just throw your stop in and you just remember 92. So far it's holding above that. I know it's been a month, but sometimes these stocks can take a month of sideways before they ultimately go. But when they go, they go. So for example, and I can get rid of some of these lines. I just leave them in the past. I don't want too many lines on your charts that other people don't have, but if you did buy on a high volume close, like, when it got over 350 for app, that's pretty obnoxious because you stopped out here. Maybe you get in again. Maybe you even get stopped out on this earnings. But what can happen, this is a better example, right, is you sit in a stock for a month and then finally you get a move up and maybe you get chopped out. Sometimes you have to be in a stock that doesn't go down right after earnings. Netflix being the most beautiful example probably from this year of a straight 40% move, which might not seem like a lot until you realize it's a $100 stock trading 50 million of volume. So we're talking $5 billion a day. So the reason we trade these big stocks, big market cap stocks that don't move as much, is you can get cleaner moves. So you can take tighter risk. And the reason the moves are cleaner is that institutions are accumulating over days because they have to take huge positions. They can't get into little stocks like TVTX, which is shaping up right now, or stocks like PARR, which was shaping up and then sold off a little bit. Another one could be NAMS, some of these little biotech names that are sort of choppy and trade, $1 million, $40 million a day. Institutions, funds can't buy those, family offices even. And so they do look for these massive, the Spotifys of the world that have enough liquidity where they can get in over multiple days. Spotify is probably one of the worst examples of actual price action that followed this trend because it's so choppy. But Spotify has always been choppy. It's kind of in the AAOI category where you might get a day up that's super exciting, but in general, this is not a stock you want to wrestle with. So past price action is indicative of future price action. Another stock in this optical category, CAHR or even light is even smoother, are better examples of that. And here's a perfect example of, again, the earnings situation. If you buy after earnings, it might take, a few weeks until you get over that level. And, here's another earnings example, which has been challenging, but at least you have a clear level to buy over. So, it might break that level a couple times. You might get stopped out twice. This is the reality no one wants to talk about, is you might lose 1% on a 500K account, a 10% position, percent on that is only $500, but you lose $1,000 on this stock. How excited are you? Lose here, you lose here. How excited are you really to buy it after it goes above that level again here? Maybe not that excited, but you keep using that 50,000 position. Maybe your account's down a little bit, so you lost $1,000. It's a $49,000 position at this point. But eventually, you do get that 10% move. You trail half of that position. You sell here, or you just hold, and suddenly, on average, your cost basis gain, whatever, is 30%. So you've made 30% on 49 grand, 50 grand, call it, and suddenly you're up almost 10 grand, which totally cancels out that $1,000 of loss. So that's where the 33% win rate, proves its metal, it shows its colors, whatever. There are some metal names shaping up, actually. TMC looks pretty interesting right now, sort of a flag situation like Lemonade that I was looking at. It has this clear level over 8.2, and it's the same situation. I mean, we can look at the past to see what might happen here in the future, but if you see, these are kind of so quick flags that they're not good examples, but somewhere in here, let's say that you bought it here, this would have been pretty stupid to buy. Anytime something is just wedging up, I mean, that doesn't look that interesting, right? It actually looks a lot like some of these recent, NBIS names. There's a reason I'm not saying to buy NBIS right now. But anyway, I understand this explanation is very visual and I ought to be more fundamentally focused, but the reality is that the technicals are examples of what's actually happening on the chart, and the fundamentals are stories, right? Which do need to be told, but don't need to be dived into in detail. So anyway, let's say you lose 1% on TMC. In reality, on this stock that's 585, losing 1% is difficult, right? 58 cents is not very much. You might lose 2% on a stock like this because it just whipsaws so quickly. So you lose once here, you try again, you see a flag here, and maybe you somehow stop out here. Some of these wicks are pretty nasty. It moves 9% a day. So now you've lost 4% on this stock. But eventually, when you do buy, and you get it in a way where you don't get stopped out the next day, you can get that 50, 40% move, and suddenly losing 4% is nothing. So you literally can lose more than you win on an individual stock in terms of entries and still come out ahead. But those are just a bunch of flag examples. Flags are not the only way to buy these stocks. Another way is, Lemonade is a flag, but if we look at some of these other companies, EOS is an example, what they also have done is come down and then formed higher lows. So you're buying over a base, sort of a base breakout, And if not EOS, well, another one that might be interesting, trying to think of levels here. Cipher is a good example where you had this level up here. It sort of went up here, came down like it's a peak on the left side, and the price went under that, it undercut it, and then went back above. So you can buy as it comes back above that peak or as it undercuts it, and that's another way to get 20-30%. So pretty innovative different ways to buy these companies. But right now, Ulta and Urban are the earnings ideas that I want you to take away from this. So hope that helps. If you like these ideas, hit that like button. If you want a free course on how to find the next NVIDIA without gambling on startups, hit that subscribe. And if you like this talk or you want to chat about your portfolio, head over to stockscommunity.com. The link's in the description. 7-day trial for $25.
Sam Putnam.
This is Sam Putnam. This is Sam Putnam.